We are optimistic about the outlook for equities next year. This is due to the ongoing monetary policy support leading to low rates for an extended period, the sizable fiscal stimuli being deployed across the globe, and the normalization of economies that should occur once mass vaccinations are underway. It is going to be a year of certainty in recovery, but lack of certainty in magnitude of such recovery. The recovery from the pandemic is likely to bring a sizable rebound in economic growth and in corporate earnings. The forecast error, however, remains high, given that we are likely to be facing an initial ongoing weak activity in the first part of the year, whilst we are still cautiously handling the pandemic crisis, before a strong recovery once economies normalize in the second part of the year. Magnitude and pace of recovery will in large part be dependent on the speed of channeling into the economy the sizable fiscal stimuli announced, which so far represent between 8 and 16% of GDP for the major economies globally. In terms of valuation, US equities are appearing more stretched versus historic average, whilst European and Asian equities still offer some attraction in our view. The low yield environment will remain challenging for investors seeking yield next year, which makes it supportive for equities in general, given their still very attractive earnings yield compared to bond yields. We believe that there will be an interesting debate around inflation and expectations of pickup in inflationary pressures next year. From our point of view, we don't see any meaningful and sustained pickup in inflation, given the many underlying deflationary undercurrents brought by disruptive trends remaining omnipresent and the underlying weak labor market dynamics brought up by the pandemic crisis. The question in 2021, if we see a pickup in inflation, is how long will interest rate expectations remain subdued, or will anticipations of rising rates bring some downside risk to asset classes, notably equities? In terms of geopolitical risks, the Biden presidency will bring a constructive rather than destructive approach to diplomatic matters, which is likely to bring less trade uncertainty generally, and therefore less volatility in markets. An additional risk to watch out for is the formation of excesses in asset classes. The low rates environment and the plentiful access to cheap funding is pushing investors into riskier asset classes in search for yield. This has the potential to create some localized market bubbles, which could bring some risk to investors further down the line. Furthermore, an additional risk is one of ongoing increase in indebtedness due to the fiscal spending programs announced. Higher debt levels tend to be followed by periods of lower growth and higher tax. Whilst not necessarily a consideration for 2021, investors should be mindful of this risk in the midterm. Another important aspect: financial markets, investors, asset allocators, corporates, and all economic agents will continue to increase their focus on ESG and their preference for more sustainable approaches to investment, production, and consumption, all of which should be positive both for stewardship in general, for responsible corporate citizenships, and for tackling climate change in the long term. In terms of thematics, for us, the structured growth opportunities related to increased infrastructure spend will be an important driver not only in 2021, but over the next decade and beyond. This increased infrastructure spend is likely to be channeled into 6 areas: healthcare infrastructure, greener buildings, electric transportation, renewable energy, 5G telephony, and high-speed railways. These spending areas all sit within our 3 megatrends of demographic changes, future of technology, and resource scarcity. Finally, as investors, we want to continue to focus on companies with sustainable business models, solid balance sheets, structural growth opportunities and generating high returns, and that have low disruption risk and strong pricing power in an environment that remains disruptive and where there is a lack of meaningful inflationary pressures.